1 minute smarter, every market clearer. Welcome to my channel, I'm Claire. Hello everyone, and welcome to today's deep dive. In this episode, we aren't going to talk about fleeting market noise. Instead, we are diving straight into the deep waters of the economic system to deconstruct an upcoming macro chessboard, one that has been personally acknowledged by the highest echelons of power. U.S. Treasury Secretary Scott Bessent recently signaled something in a historic television interview that no veteran investor can afford to ignore. He stated that while the stock market's performance in 2025 is impressive, it is merely the overture. The real main course won't be served until 2026. This sounds like a generous invitation to a banquet, but to those of us accustomed to deconstructing policy logic, it is actually a clear disclosure of the government's whole cards. If 2025 is a year of markets feeling their way through the fog, the logic for 2026 has been simplified into 4 words. Follow the money printer. Why does a high-ranking official in charge of the nation's financial lifeblood dare to promise such an asset feast so definitively? Behind this confidence lies an unprecedented consensus reached between the government, the Federal Reserve, and the White House to push up asset prices at any cost. Let's take a closer look at the 3 core pillars supporting this 2026 feast. First is the dramatic U-turn in the Federal Reserve's role. After a long and painful cycle of quantitative tightening, QT, the Fed's policy scales will tilt completely in 2026. Data suggests that QT will officially end, replaced by a new round of quantitative easing, QE. Put simply, the printing press leading to the market will be restarted. When the Fed begins buying treasuries and mortgage-backed securities, it is effectively injecting the freshest, most direct liquidity, blood, into the entire banking system. I find this point fascinating. This money will never sit quietly in bank vaults. It must find a destination. In the specific environment of 2026, the most direct and surging destination for this liquidity will be the stock market and various high-quality assets. We must remember a fundamental law of physics. When the total amount of currency in circulation surges while the supply of high-quality assets remains relatively limited, rising asset prices are no longer a matter of probability, but a certainty. Second is the money-dropping mode of fiscal expansion. If the Fed is opening the floodgates through monetary means, the White House is directly scattering cash through fiscal means. According to the latest 2026 budget, the U.S. plans to generate a fiscal deficit of approximately $2 trillion that year. This is a figure large enough to shock any conservative. A deficit means the government spends far more than it collects in taxes, so where does the difference come from? The answer is issuing debt. This massive capital, converted from debt, will flow continuously into government contracts, infrastructure construction, technology subsidies, and various social welfare programs. Eventually, these funds will converge through countless small channels into a great river, flowing into corporate balance sheets. For example, when giants like Boeing or Intel receive massive government orders, their profits increase directly and their stock prices rise. Investors holding these companies are, in effect, getting a slice of the pie in this national-level wealth distribution. The third pillar is the ultimate control of interest rates. As current Fed Chair Jerome Powell's term nears its end, the Trump administration has clearly expressed its expectations for the next leader. It must be an extreme dove. Trump has even publicly mentioned his desire to see interest rates drop to the 1% level. While rates may not hit zero instantly due to inflation concerns, the downward trend has become an irreversible consensus. This low interest rate environment means 2 things for investors. First, a cliff-like drop in borrowing costs, which will greatly stimulate corporate expansion and individual consumption. Second, a reduction in the discount rate, which directly boosts the valuation of growth stocks. When you can only get a meager 1% interest on your bank savings, while the real inflation rate may be much higher, your only survival choice is to swap your devaluing currency for assets that can appreciate. However, before the celebration, we must look back at a set of extremely anomalous data left behind from 2025, which may be the darkest footnote behind the feast. The stock market rose 19% in 2025, which should have been satisfying. But interestingly, data shows that during the same period, gold rose by 72% and silver soared by an astonishing 174%. This phenomenon of a double bull market in stocks and gold, where precious metals far outperform stocks, is very rare. In normal financial logic, gold is the safe haven counterparty to the stock market. But in 2025, gold and silver defeated the S&P 500 with overwhelming advantages. This divergence releases a clear signal: panic. Gold's rise is never because its industrial value suddenly exploded, but because global investors have developed deep doubts about the long-term credit of fiat currencies, especially the US dollar. Historically, periods where gold outperformed stocks by such margins, such as the Great Depression of the 1930s, the Great Stagflation of the 70s, and the 2008 financial crisis, all foreshadowed systemic credit turmoil. The 2025 surge in precious metals is actually the market voting with real money. People sense the madness of the printing press and the return of inflation, so they are rushing for a safe harbor. This means that while the 2026 feast is magnificent, its underlying color is the systemic devaluation of currency. So, why doesn't the government just give this money to ordinary people to eliminate poverty entirely, instead of insisting on creating this prosperity by driving up asset prices? I've found that this involves a cruel systemic truth. The current economic system was designed from the start to serve asset owners. This systemic bias is deeply rooted in two dimensions: law and taxation. Under the legal framework, let's look at fiduciary duty. If you look closely at a US-listed company, you'll find that the CEO's legal obligation is not to serve employees or even customers, but to hold the highest fiduciary responsibility to shareholders. This means the CEO's primary professional task is to make the stock price go up. Interestingly, if a CEO causes profits to fall and stock prices to crash because they gave employees high bonuses, shareholders can even sue them for breach of duty. This explains why, during economic volatility, we often see companies announce large-scale layoffs while stock prices hit new highs. Because in the eyes of capital, layoffs are cost optimization and loyalty to shareholders. Then look at the tax system, which might be the most heart-wrenching exploitation of the working class. Under the current system, an employee who earns a W-2 salary by selling mental and physical labor may face a top federal income tax rate as high as 37%. But if you are an asset holder living on stock dividends or capital gains, your top rate is usually only 20%. This means a hardworking doctor earning $1 million a year might pay twice as much to the government, proportionally, as an investor sitting at home collecting dividends. This system isn't just encouraging investment, it is using taxes to directly reward those who hold assets. I'm reminded of the stimulus checks during the pandemic, which was actually a classic case of wealth transfer. Many people felt the government was providing relief to the poor, but from a macro perspective, the government was using the hands of the poor to transfuse blood into large corporations. When an average family received a $1,000 check, they went shopping at Amazon, ate at McDonald's, and paid streaming media fees. After one round, that $1,000 ultimately flowed to large multinational corporations and into the stock market. The poor got temporary consumption satisfaction, while investors got corporate profit growth and long-term stock price appreciation. This is the secret path of wealth transfer. Even more interesting is that the speed of this wealth return is now considered too slow. A more aggressive trend is emerging in 2026, the rise of state quasi-capitalism. The U.S. government is directly using tax dollars to become a shareholder in listed companies. In the past, this only happened during the deepest crises, but now, even as officials claim to be in a period of prosperity, the government can no longer hold back. Taking MP Materials and Intel as examples, the government is not only providing low-interest or even interest-free loans, but also directly purchasing shares or providing strategic subsidies, and even deeply intervening in their supply chain restructuring. This is a massive signal for investors. If you don't know what to buy, look at what the government is buying. When the government injects tax money into these enterprises, it is effectively endorsing their stock prices. This direct intervention largely eliminates market risk because the government will not allow its heavily weighted benchmark companies to fail easily. This is an unprecedented policy dividend and a complete distortion of free market competition logic. Faced with a 2026 that is highly distorted by policy and strongly pushed by capital, how should we as ordinary investors survive? I have summarized 3 core laws. The first and most important, don't fight the money printer. Wall Street often says don't fight the Fed, but in 2026, this needs to be upgraded to don't fight the money printer. When the top levels of power have clearly reached a consensus to dilute debt by pushing up assets, any attempt to short the market is going against the tide. Moving with the flow of capital is the first prerequisite for survival in 2026. The second law is to embrace volatility. We need to understand that even with the support of the printing press, the market will not move in a straight line upward. Crashes, pullbacks, and even black swan events will still happen, but in the era of the money printer, the logic of a crash has changed. In the gold standard era, a crash meant a decade-long depression. In the money printer era, a crash often triggers an even larger bailout. Just like when the pandemic broke out in 2020, the faster the market fell, the harder the printing press worked. Therefore, for long-term asset holders, a pullback is no longer a signal to liquidate, but a discount on quality assets and a gift to enter the market at a bargain. The third law is to be a long-termist spanning decades. Investing is not about making fast money next week. That's speculation. True investing is launching a long-term war to defend wealth. If you look at currency trends over the past 40 years, you'll find that if you only held cash and savings, your purchasing power was being constantly diluted. In this system, holding core assets, whether it's equity in high-quality companies, real estate in core locations, or precious metals as hedging tools, is the only way for ordinary people to beat inflation and achieve class upward mobility. While 2026 is described as a feast for investors, we must soberly examine who exactly is paying for this expensive bill. Wealth is not created out of thin air. The explosion of asset prices is essentially a targeted dilution of currency value. As the money printer spins madly, those who hold no assets and rely entirely on fixed salaries are unknowingly becoming the ones paying for the feast. Their cost of living is rising, and the purchasing power of their savings is shrinking. This silent transfer of wealth is exactly the widening chasm between the asset class and the working class. In the financial world, the gap in perception is the watershed of wealth. This system has changed the rules of the game. It no longer rewards those hard workers who keep their heads down, but instead favors those asset holders who understand the rules, see the trends clearly, and dare to cross the volatility. Complaining about the injustice of the rules is futile. Complaints cannot protect your savings, nor can they resist the erosion of inflation. The only thing we can do is to complete the identity transformation before the wealth bill is sent out, from a mere provider of value to a holder of core assets. Of course, following the trend doesn't mean taking blind risks. Even at a feast, some will swallow poison due to greed. Your task is to identify those few true main courses, the high-quality assets that possess core competitiveness and can withstand the test of time. The investment environment of 2026 is an ultimate test of everyone's cognition. If currency devaluation is an irreversible process, then in the next decade, what do you plan to use to define your wealth? Is it that shrinking, symbolic number in a bank book, or those hard assets that continue to generate value for you amidst the stormy waves? It's like a rising flood. Some people choose to build a house on the sand and pray for the water to recede, while others use their resources to build a ship that can rise with the tide. This flood in 2026 is determined by policy. It is inevitable. What you need to do is not try to block the flood, but ensure you are on that ship called assets. The feast is ready, the lights are on, and the music has started. Everyone faces a choice: to continue indulging in the old dream of savings is king, or to bravely embrace the new rules of assets first? The answer lies in every choice you make next. Thank you for watching, and I'll see you in the next episode.